The Indian markets entered a volatile territory in the past couple of days. But is volatility here to stay? With global tensions simmering and the Fed ready to hike interest rates, will bears rule Dalal Street in the coming days? We have market master Arvind Sanger joining us to take stock of the markets. Arvind Sanger of Geosphere Capital joining us on the show. Arvind, great to have you with us on BT Brainstorm. Let me first get your verdict of the budget this time around in terms of indicators and cues for the markets and for the economy going forward.
Well, my biggest concern going into the budget, it was about populism, given that there are elections, there were elections in the pipeline when the budget was announced. Luckily, the government resisted the temptation to go populist. It maintained fiscal discipline, and it invested in long-term future by extending the investments on the infrastructure side. So there were those were the major positives in the budget that it was. And another important point was it was very realistic. If I would blame it for anything on the realistic side, it was a little too conservative in its revenue assumptions, which is rare for governments to do, because the temptation is to overassume money and then go and spend it. And here they were underassuming what the real revenue dollars might be. I mean, revenue rupees might be.
Arvind, what do you feel led to the conservatism? Was it fears about, the pandemic receding, this particular wave receding, crude oil prices, the global backdrop? What do you feel was the primary reason?
I think it is all of what you said. And I think there's also some nervousness. I assume about global macro headwinds in terms of rising interest rates globally, certainly from the Fed and now other central banks, Bank of England, ECB, all talking very hawkish, and concerns about oil prices, all of which could be a headwind to economic growth and therefore to revenue projections. So I think they've allowed enough of a cushion that I think many of these risks are discounted in the budget.
Well, while talking about that, share with us what you're expecting from the Fed. They've indicated, of course, a spate of hikes, how soon you see them kicking in, and again, the kind of implications this will have for global markets.
I think the first one, the Bank of England has already done two. Fed is definitely going to do the first one in March. I don't see anything that prevents that. I think the first couple of hikes are in the bag, so to speak, in terms of happening. But the benign hope is that some of these inflation forces will abate quickly as economies recover from Omicron, and you start to see some of the supply chain challenges start to abate. But my big concern is China's zero COVID policy is going to be one of the major impediments to supply chain normalization and therefore to inflation abatement. I was talking recently to a shipping company, and their concern was, and shipping is one of the major bottlenecks because the Chinese have seen many lockdowns in ports, and their concern was that if there is a major increase in Omicron cases in China, you could really have a major shutdown of ports. So right now you've had periodic single port shutdowns, and if that happens, there could be a real logjam. So I think some of those concerns are real. I'm not sure how raising interest rates helps, other than tamping down growth and therefore slowing demand. And that's one of the risks for the global economies, is that they have to they can't manage the supply chains, they can only manage the demand side. And so that would be one of the risk factors.
Crude oil has, of course, been a burning issue, and given the current backdrop with geopolitical tensions, Russia, Ukraine, and of course, supply side issues that we've seen, how do you feel this is going to play out? Are we going to continue to see oil prices spiral higher?
Well, it's really not about Russia, Ukraine. I recently launched a fund which I call the Brown Tech Fund. Okay. And the reason I launched it is because my assumption was that energy transition is creating phenomenal opportunities as an investor in the resources space. And what you have to realize is what is not often commented on is that natural gas prices, LNG prices in Europe, the month and a half, 2 months ago, got to the equivalent of $300 a barrel. And LNG prices in Asia, Japan and Korea, got to $280 a barrel. So oil is only at $90 a barrel. The reality is that because of ESG pressures, nobody's investing enough in new capacity, and demand is increasing rapidly. Natural gas was power related, and oil is, revenge travel. People are going to come out of Omicron and want to travel a lot, and car usage is growing, and electric cars is still a tiny portion of global car sales. So we are going to see some huge demand increases, all-time high, and you are not seeing a similar investment or supply response. So I think that the risk on oil prices are very much on the upside. There's one negative for oil prices, or one optimistic view for an oil consuming country like India, which is that there might be an Iran deal, which the US Biden administration is quite keen for. And if that Iran deal were to happen, of allowing them back into that agreement that had been signed under President Obama, then that could near term alleviate the pressure on oil prices. But I don't think it solves the problem that the world is going to be very tight on spare capacity by the end of the year, with or without Iran. And therefore, oil prices have a lot of upward bias. And I'm not talking about Russia, Ukraine. If we ever get Russia, Ukraine, I mean, oil prices last high was $147 a barrel. We'll go through that if we really try to put pressure on Russia, if they invade Ukraine. I'm hopeful that that will not happen.
In terms of inflationary pressures, and we have been taking a look or monitoring really the glide path here, when it comes to what's anticipated over the next few months, whether it be, of course, on the back of crude prices or otherwise. Tell us, Arvind, what are some of the key themes that you think will be good to watch out for, given the current macroeconomic environment?
Well, inflation is definitely a theme which is global. And I think in India, we have seen some hardening of inflation data. People that I talk to are seeing it in everyday purchases of, food, vegetables, and also a lot of consumer goods. You had Hindustan Unilever talk about demand pressures that they were seeing because of inflation cost pushed in rural India. So there's a lot of signs that inflation is creeping up in India too. And obviously, petrol prices, diesel prices are certainly not, not benign, and therefore they're also feeding this inflation narrative. So I think that one of the risks is that RBI does not get too far behind the curve. Obviously, RBI needs to be more, circumspect, because a lot of global developed and emerging market central banks have already raised interest rates. So hopefully RBI is headed down the same path. Obviously, they have started to lessen some of the support that they were providing, but I think it's important that we continue to see RBI stay on the right side of the inflation curve, and so that's a risk for India. And as we've discussed, oil prices are a risk for India, and global liquidity is a risk. India is still, I think the current account deficit is going to go up as oil prices go up and as domestic demand recovers. Last year, India benefited from domestic demand being weak and international demand recovering, so current account deficit was quite low. This year, we could see current account deficit widen, both from oil import bill and from domestic demand recovery. Therefore, foreign capital flows, which have been negative on the portfolio side, are going to be worth watching, and therefore, the rupee is another risk factor for us global investors to keep an eye on. So far, I think there's been enough flows from private equity and other investors to offset the FII portfolio outflows. But I think 2022 could be a little bit more of a, tricky year from that front.
We have seen some volatility of late, particularly on the back of some of those tech names like Meta. Is that a theme that's done with for the moment, or would you still look at select pickings when it comes to the tech universe?
Well, as the era of free money ends, the leaders of the last cycle will not be the leaders of the free cycle of the next cycle. Okay. So if you go back to the early 2000s, we had a cycle through 2008 global financial crisis, during which period tech stocks did terrible and commodity stocks and emerging market stocks did great. If you look at the post global financial crisis from 2009, 10, or maybe 10, 11 onwards, emerging markets and commodity markets did terrible, and NASDAQ and tech stocks and the US S&P did great. So I think that the leadership is changing again after COVID and the new cycle that is beginning. And I'm quite hopeful about emerging markets, and I'm very hopeful about commodity resource stocks. And I am much less optimistic, although my main forte is not investing in tech stocks, but I think the headwinds you're seeing is that a lot of these companies whose earnings are way, way, way into the future, a lot of these unicorns and the recent startups with great promise, but with earnings that are way into the future as interest rates go up, the future value of earnings when you discount it to the present value comes down dramatically, and therefore I think that this is a headwind that tech companies market is going to be much less forgiving of, and some of these growth stories that have been great for a while might see some headwinds on growth.
And what are some of the growth stories or growth areas that you're looking at, Arvind? Would they be deep cyclicals? Is that where you see momentum coming back?
Well, certainly, I'm looking at commodities, metals, energy is an area where that we like. We like real estate because, again, real estate cycle was dead for the last decade. And I think, a lot of what we in the US refer to as household formation normally results in housing demand. Yeah. In India, housing demand has been dead for, in terms of any growth for the last 6, 7, 8 years. Household formation has still been taking place. The demographics have been supportive of that. So there's a lot of pent-up demand that we expect to result in housing demand, and inflation also causes housing demand. So many factors which will drive real estate cycle to come back after a decade in the wilderness. So we like that. We like the CapEx cycle. We think, again, we are in the early stages of a CapEx cycle, and therefore that would be a sector would benefit. There are some E&C companies, again, engineering construction companies had a terrible decade. Those could come back. So there's many things. The IT services have done very well in the last couple of years, but we think there is a huge new digital and outsourcing on steroids because of stay at home. And if you're working remotely from your office in New York as a financial services industry, you could be outsourcing that to somebody in Bangalore or Delhi as easily. And that has opened a whole new range of outsourcing opportunities. And the acceleration of digitization is creating opportunities. So we think IT has a lot of tailwinds, but it's probably the sector that has done the best in the last couple of years. So one has to be a little more careful about valuations and entry points. But I think if you take a longer term cyclical view or a cycle view, then there is still room on those fronts. So those are some of the areas that we are most interested in terms of the next cycle coming through.
How do you see India positioned in the emerging market landscape, and also vis-a-vis China? We have seen investor sentiment sour somewhat given some of the policies coming out of China at the moment. Do you see some of that money continuing to move towards India?
Well, I don't know that India can be dominant in the way that China is dominant. Remember, China's economy is 5 to 6 times India. So we're comparing really probably different scales. But I do think that China has embarked on a different stage of its growth cycle, and where the government is now saying, okay, we've grown fast enough, we need to focus on redistribution, fairness, all of those things, and therefore they're handicapping some of their high growth sectors. India is sitting in the right place, right time, and unfortunately, one of the things that I can say about India is India is an expert at missing opportunities. Unfortunately, that's been true of India for the last several decades. And that is up to the Indian business people and the Indian government to put in place the right structures. And I will tell you the one negative that I worry about in India. I know the flavor of the month is Atmanirbhar Bharat.
Yes.
The last time we went Atmanirbhar, we got Fiat and Ambassador cars. So my concern is that closing off India, not entering trade blocks, raising tariff barriers to protect domestic industry is the wrong way to build a world-class industry. The right way is, yes, you want to build world-class businesses to come. You want to create the infrastructure. You want to create the environment for it. But you also don't want to put too much protection, because protection creates low-quality growth rather than high-quality world-class growth. So that is the real challenge, that India does the right things. Any crutches provided are very temporary, have very strong sunset. We haven't seen signs of that, where they say, okay, in 3 years, it's going from 20% tariff to zero, and you have to, in 3 years, survive. There should be a very clear roadmap. I haven't seen that yet, because the risk is that this is the nature of businesses, that they will ask for continuous. And Indian businessmen are very competitive if you give them the right framework. But if you give them this crutch, like any business anywhere in the world, they will always find reasons why we need more crutches forever. And that is the nature of business and the temptation for governments to give in. And I think that, so the Indian opportunity is phenomenal, but it needs to be with world competition, so that we get world-class companies that are able to compete at a world scale and to be able to export. So that is the opportunity for India, and that is the challenge for India. So in terms of capital flows, right now the capital flows are coming in, and right now there is interest in India. But it is here today because there is the promise that the China plus one is creating opportunity. The size of the market is creating an opportunity, but there is no guarantees in life. It is up to India to seize this opportunity and to put in place the right policies to make sure that businesses are treated. This retroactive taxation has gone for now, but are we going to see stable policies where people can predictably invest, and there are not going to be changes on taxation, on capital gains, on profits? Because unfortunately, the history of Indian bureaucracy is they always find that if people are making too much money, how do we take the money away? And I think that's a big temptation. So we need to put in place, I'm not saying that businessmen should make free money, which is why I'm saying that the tariffs barrier should be reduced, but the predictability and the visibility, which has not been India's forte ever, predictability and therefore the ability to invest with a clear idea of what's coming would be critical for India to sustain this cycle.
Do you think the government will be able to stick to the kind of trajectory it's set for itself? They were very surprising in being a non-popular, especially when the budget came at the time or at the cusp of assembly elections. Do you think that they'll be able to maintain that going forward?
I would say that, look, the last two budgets, first of all, I don't give as much importance to budget as I do to policies, and budgets are kind of a signpost along the way in terms of policies. And in India, I think people pay too much attention to budgets. In the US, we haven't even passed a budget ever, but it doesn't really matter. For a number of years, we have not passed a budget. We keep doing continuing resolutions, as they call it. But at the end of the day, it's the bigger policies, the regulatory framework. Tax, when we lowered the corporate taxes from 35 to 25, it was not part of the budget. It was allowance in the middle of the year. So some of the biggest moves have come extra budget. So budget is not that be all and end all. I think even the retroactive taxes didn't come through a budget, that came through some other steps. So my point is, at the end of the day, it is important for India to demonstrate a policy framework, not a budget framework, but a policy framework, which is predictable and reliable and isn't prone to, okay, now we need to do this certain things to fill the budget gap, or now businessmen are making too much money, or now these foreign investors made too much money. So how do we get something back? That's not the goal. Let us all make money together as long as India can create growth and jobs. That's what matters. And that should be the common objective, not seeing who made money and who didn't. As long as it's done in a fair, transparent, and predictable form, some people will make more money than others, some businesses will do better than others. And it shouldn't be to punish those who do well. It should be to create a framework that provides a predictable pathway to people to invest. And therefore, I think India needs investment, both domestic and foreign, in growth, in capital, in job creation. I think one of the biggest challenges for India, frankly, is the lack of job creation. And the lack of job creation is really, really concerning for the political system should be worried more about it than I think it is right now. And I think that is one of the challenges, and the only way to create job is mass manufacturing. And for that mass manufacturing and for all of that growth, including small business growth, we need more incentives for small and medium scale enterprises, because the majority of the jobs around the world are not created by the large corporates. They're created by small and medium enterprises. And you need a virtuous cycle for those, including the more lending by the banks and the non-bank NBFCs, and by I know we've moved through a formalization of the economy, which has actually hurt the small and medium enterprise. But we need, within the formal framework, rather than in the past, so informal framework, we need more job creation there. And that's really one on which neither this budget nor any of the policies have done enough to address that. And I think we need more measures to, the PLI schemes are meant for big companies, and hopefully they will create jobs, but we also need more of a framework of support for small and medium enterprises.
And Arvind, what if we do see the Fed hike rates in terms of money moving into India? How are we going to be impacted? Do you feel the domestic story is going to be strong enough to carry us through?
Yes, it does. I mean, if you look at the past interest rate cycles in the Fed or others, India is, in a growing global economy. India does fine in a rising rate cycle. It is important that it participates in that growing global economy. And it's not like, US is growing and the rest of the world is not, then it's a problem. But as long as India continues on its growth path, Fed raising rates, as long as it's moderate and predictable, and it doesn't cause a recession in the West, India's growth story will be fine. But, if the West goes into recession, the history of recessions is such that it does not, even though India is not as linked, it wants to be more linked, right? With this PLI and everything, we're trying to be doing more exports. So we can't have it both ways, that we want to be linked, but if there is a recession in the West, it won't matter to us. That doesn't work. So therefore, I think as long as the Fed doesn't raise interest rates enough to throw, Western central banks don't throw the world into a recession, I think the India growth story stands on its own legs, but it needs global growth to be relatively continuing. It can't count on global recession for it to do fine. So that's important.
Amazing. Arvind, thank you. That was so fabulous. Great speaking with you today.
Thanks, Aabha. Enjoyed it.